What's up, you guys? Zoeb here from OneGlanceTrader.com, and I'm really excited to be sharing with you my brand new indicator, the OGT ADR. And the ADR stands for the average daily range. And basically, what this indicator does, it gives you a feel of the daily volatility inside a currency pair. So I'll be going through in this video how this is calculated, what are the settings of the indicator, and what you can change. I've got the indicator on my screen now. I'll go through what all these numbers mean, what these lines mean, and then most importantly, I'll walk you through how you can apply the ADR to your trading. So let's get to it. So as I mentioned, the ADR, or the average daily range, is a daily measure of average volatility inside a currency pair. And the way it's calculated, it takes the pip range from the high and the low over X number of days, and then gives you an average over those number of days of what the potential daily volatility is. And it will gives you then, a kind of a box window to show of the current trading day of how much a currency pair is likely to move. So before I go into all this detail of what we can see on the chart, let me just walk you through the indicator settings. So the first thing is that for those of you who actually trade the ADR and use it, you might see some of the same variables that are in other ADR indicators, and I've kind of amalgamated 3 or 4 of them into my own, kind of used the same wording because it just makes sense to do so, but I've added my own little twist instead, which I'll go through in a second. So the first thing is making sure that your start of the day is aligned with your broker. Again, what broker I'm using is slightly behind, so then I've had to go back to -1 to align the day. So as you can see, this kind of line here that I'm hovering my mouse over shows you what the start of the trading day actually is, and then that line will create the next day as the days continue. And the ATR, which is the average true range, again, it tells you how many days you want to look back to calculate the ADR, and I've chosen 15 because I think 15 trading days is enough of an average to give you a kind of sense and a feel of how much a currency pair is going to move in the future. So the next two pieces are all linked to this area over here, which I'm hovering at the moment. And what this is showing here, it is showing how much the currency pair has moved over the last X number of days in relation to the ADR. So on the top left hand corner, the ADR gives you the calculation. So what it's doing here is it's taking the high and the low over the last 15 days, dividing it by 15 to give you 598, so basically 60 pips. And it's telling you here that over the last 15 days this currency pair moves on average 60 pips a day. It doesn't take the direction or anything, otherwise you'd be a mind reader, but it tells you that it's going to move around 60 pips a day. And what this section over here today is saying is that in today's trading session, and again this will change live as the markets evolve throughout the day, today it's moved 47 pips. And what this settings are telling you is what it's done is looked back at the last 200 days and had a look to see of the ADR, which is 60 pips, how much has it moved in the last 200 days for that. So for example, it's saying that the currency pair has moved at least 10% of the ADR, in this case 60 pips, 100% of the time in the last 200 days. So we can say for fact that the USD chef has moved at least 6 pips for the past 200 days. That's what it's saying. And then if I look at the last one here between 90 and 100%, that it has only moved 60 pips 39% of the time in the last 200 days. So again, you can just start to imagine how vital that information actually is, and that's what this data data tells you, and we'll go on to how you can use that as in a second. And then the next one is you can actually look at this data based on the actual ADR for that particular day. So what this does, it looks at, if I select that and just hit OK on that and let that refresh, what this is saying is that let's just do this 60 to 70%. What it's saying here is that over the last 200 days, regardless of what the ADR was, it achieved the ADR. It achieved 70% of the ADR 80% of the time. And that's basically what it's saying. So it's not taking into account today's, or when I say today's, as in the last 15 days ADR calculation. It's just looked at how much of its actual ADR for that particular day it hit over the last 200 days. So for me personally, when trading, I actually thought that the ADR way was the best way to kind of visualize this data, but actually I think that using the ADR for the past 15 days and how much price has moved over the last 200 days in relation to this number is more of an interesting number, especially when I'm trying to understand is, will this currency pair move 20 pips? I can do it in relation to an actual number of which this data is calculated. So that's how I've set the default, and that's how I trade it. Now the next piece talks about these lines over here, and before I go into the settings, I'll explain what these lines are. So once the ADR has been calculated, what it does is it sets upper and lower bands based on the high and the low. So for example, if we take the high of the day, and then it will measure what the ADR is, so 60 pips, and measure 60 pips down. Yeah, 598. So it then gives you a view on what is 60 pips from the high, and then as you would imagine, the upper takes 60 pips, from the low and projects that high. So then it gives you what is the potential is going to move up and what's the potential is going to move down. So then it sets that kind of barrier in there, and then what happens as the trading day evolves, as new highs and lows develop, these lines move and will always keep the distance. So if a new low forms here, this line will drop down but maintain a 60-point gap from the high and the low. So you've always got a visual representation on how far price is away from hitting its average daily ADR. And as you can see here, that it only did 47 pips, and it's was nowhere near hitting its ADR, the average ADR for that day. And then all that is this inside the indicator is that if it doesn't hit the ADR, you can set a color, a line thickness, and you can change it from dashed to not dashed, etc., etc. And if it does hit the ADR, you can set the thickness and the color. So what I've done is you can see on this screen, on the Aussie dollar, New Zealand dollar, you can see that when it hits the ADR, it turns green, and when it hits the ADR, these lines then stay fixed. So don't worry about these arrows. I think we can talk about that inside a second. But yeah, so again, it gives you that information of when it doesn't hit the ADR to when it does hit the ADR, it changes color. And again, you don't have to do that. You can keep the same color. It just gives you a quick, easy representational way to see whether it's hit the ADR or not. So those are the settings, and this is the kind of information displays based on that. So the key question is how do you trade and apply this indicator to your trading? And particularly if you're a long-term swing trader and things like that, it's probably good to know what the ADR is, but you probably wouldn't use it that often. This is really mainly used for intraday traders on a number of things. So the first thing is setting stop losses and profit targets. So let's just say, for example, I don't know, let's just say you got a signal here to go short. just for argument's sake, and you know that the ADR is 60 pips, and you know that this is where likely price will kind of go to. So knowing that this is the average kind of daily target, there is no point setting a take profit target down here because it's unrealistic, especially if you're a day trader and you're going to try to get out of this trade by the close of the day. So what would make more sense is setting it either at the ADR level or just before the ADR level. And then this is where this data comes into play. So what this is saying here is actually, to hit 90%, it only achieves it 63% of the time, which isn't that great. Maybe I will look at 80%, 70%, which is 80% of the time. And again, I don't know what 80% of the ADR is, but it might be here somewhere. Let's just say it was here for argument's sake, just for the sake of the example. And bang, it hits that 80%, and therefore you get out at a take profit target. And hopefully this is now starting to click actually, of where you can set your take profit targets for the particular day based on the ADR and based on the historic movement of how much is achieved of either the ADR or the current average ADR that you can see on the screen. So again, this is where you can start using this in your favor to set take profit targets. And that's similar on the opposite side from a stop loss, of where you can look to see where the opposite ADR band is, and looking at this, it only achieves 90%, 63% of the time. So maybe setting it at 90% of the ADR for potential stop loss would be the ideal place to put it. So again, this is where you can use it, that if you are intraday trading. Also, where you're using it is, let's just say for example you were to enter short here, and it's only done 20% of the ADR, so it's hit 98.5% of the times the hit is 20%. So then you look at the next bracket is 95% of the time, so we're saying 95% of the time it's going to achieve a further 10%. So therefore, if you're a potential scalper in the market, understanding probably in the first 0 to 30% is probably where you want to play with. So if I'm a scalper and I've already achieved 30% of my ADR, it's probably very unlikely I want to take this trade, because as you can see, it starts to go into the 90s and then into the 80s. It's not to say that it's going to happen, but if your next profit target up, or your 2-3 point scalp is 100% or 95% of the time achieved on a daily basis on average, therefore it actually makes more sense that, okay, yes, I'll take this trade because the odds are in my favor. So again, it can potentially take you out of trades, or think about actually the movement's already happened and it's very unlikely that movement may actually continue, so therefore I'll keep myself out of the trade. So again, that's where you can kind of use the ADR and the average movement in your favor. The second way or the third way rather, is to use it for mean reversion trades once your ADR has been hit, because as you can see here, that, and it's kind of similar to a lot of currency pairs, that even though it achieved over 100%, it doesn't happen that often, 46% of the time. So when it does happen, more than likely that the currency pair will do a kind of mean reversion or a retracement of some sort for you to capitalize as a mean reversion trader. So, and mixing this up with confluence strategies, as I mentioned in my previous video, about having different technical indicators aligning, will certainly help you in your favor. So an example of this is, as you can see here, these lines are turned green, so therefore the ADR has been hit. And then for me, I'll be then now looking for a kind of reversal trade. Now, there are two indications here, or two additional indicators here, that I've put on the screen. The first one being the MACD, and what you can see here is some classic regular bearish divergence of where price is making higher highs, but the MACD histogram is showing exhaustion and making lower highs. So therefore, it's a potential indication that a retracement or a reversal is likely to happen. Um, Also, what we have here is we have all these arrows, and all these arrows are for my OGT RSI MTF indicator, which again I will share with you. The links in the description. Again, like everything, completely free, where you can where it basically calculates where the currency pair is overbought or oversold on multiple time frames. So you can see here that, I think this is set to one time frame above with 1730 overbought oversold levels. So we're on the 15-minute chart. So it's saying that this currency pair, the RSI, is over 70 reading on the 15-minute chart and on the 30-minute chart. And then, when what you start, I would ignore these two because these two are nowhere near the extremes. Is that when the arrows stop showing, so in this candle over here is the first arrow where the candle where the arrow is not showing on this candle, it means now that the RSI has come out of overbought territory, which potentially, could be the start of a reversal. And then on that on that on that candle where you don't see it is you can see that price is above the ADR, and the MACD histogram is trending downwards compared to there. So if I just look at how much that's moved around 10 points, and if you've got a 1 to 2 point spread on there, you can easily got a nice good scalp in there for 7 to 8 points. So again, a lot of people use the ADR for that particular reason, and it's actually quite interesting that that price has respected this kind of ADR level. Sometimes it will just shoot through it, but a lot of the times you'll see some consolidation happening here, because a lot of traders are kind of using this, and it's exhausted its average daily movement over the last 15 days. So again, those are some ways that you can take that and apply it to your trading. I'll be using the ADR a lot more in future videos. I'm working on a journal right now which comprises an ADR strategy, which hopefully will go live next week, so you guys can check that one out. But until then, I've got the end screen up now, so there are a number of other videos that I feel around the RSI MTF indicator, if you're interested in, that you guys can check out. So I shall see you guys very soon.